welcome to Thinking Solo. I am your host and creator, Ryan Derousseau. I'm a fee-only financial advisor, and you can find me at thinkingcapfinancial.com. Here on episode 2 of Thinking Solo, I'm going to introduce to you what you can expect between conversations with solo and small business owners. And that's some guidance and advice. And so today I want to talk about entity selection because it's something that comes up really often with folks as they're launching the business or trying to turn the business into something beyond just a little side project. And I want to talk about sort of what you need to do, what you don't need to do in those situations. And it also could be a situation where you have now really started to expand and what that means. So recently this happened multiple times where I've had a client come in and they are talking to their accountant about what type of corporation to begin with, whether they have an LLC or an S-Corp or a C-Corp or anything at all. And when it comes to service-based businesses, more than once, I've had people come in and say, yeah, I have a C-Corp. And I'll say, why'd you choose a C-Corp? And the answer is universally the same. My accountant told me to. S-Corp popularity, it's very common to see the S-Corp, whether a person comes in with a successful business or not. But the C-Corp is even worse in those situations because there's so much involved with running a C-Corp that is often limited with the S-Corp and even less so with the LLC. And so, it doesn't mean that the C-Corp isn't the right thing. It's just, it can be the wrong thing if you do it too early or for the wrong reasons. And so today I want to walk through some of the different entities and why you might or might not select them. So let's start with the most simple one and go from there. So the most simple one is called sole prop or sole proprietorship, however you kind of refer to it as. And if you've ever even made $1 in your business, then you are using the sole prop. Because that's essentially what the IRS kind of locks you into. And that's how they separate you from just regular income. But when you have a sole prop, there's no liability protection. You're operating kind of loosely. You can have an EIN number, but you don't have to. There's no tax protection by having the EIN number or not having the EIN number. But if you want a credit card or something like that, then you'll want the EIN. And then there's and you can still deduct expenses. So it's not like you can't deduct expenses just because you're using the sole prop. It's just you can't do much more than that. And there's certainly no liability protection. So if you just are running a side business with a little bit of an income and whatnot, and there's really no real concern for liability protection or anything like that, then maybe the sole prop is right for you just as you're getting started. But as we move forward, we may need to increase that entity. And the second sort of level of that is the LLC and the PLLC or partnership. So if a partnership meaning there's more than one people in the organization, maybe you're 50-50 with another business partner or friend, or maybe you and someone else have decided to team up after operating for a while and you're going to get a partnership to join together. Or I've had clients who they just operate in certain areas with a partnership of 3 to 4 people and then operate outside of that business elsewhere. And so it can be for many different reasons. But these are really easy to set up. They can have multiple owners. So if you are wanting to have, an entity where you're not doing it all, you're going to have people by your side, then the LLC or partnership or PLLC is going to be really good for you. The PLLC meaning it's more for professional specific organizations. So maybe a lawyer has to be a PLLC, therapists may have to be PLLCs, but these are determined by the states. They're not determined by the federal government. And so it kind of depends on what your state rules are and what you can operate as within the state. And so you kind of have to go with that. But at the federal level, what they count as is a pass-through entity. And so what that means is essentially you have this LLC and you're running the business through the LLC. So when you get revenues or profits, it's going to the LLC. But on the tax form, there's no LLC with the federal government. It flows to you and it flows to your personal tax return. So essentially, the business looks the same whether you are filing your taxes with a sole prop or filing your taxes with an LLC, a PLLC, or a partnership, if that's all it is, right? And you just bring to your tax form your percentage of the revenues or expenses. So in a partnership, let's say it's 50-50, you're not bringing all 100% of the revenues over, and your partner's not bringing all 100% of the revenues and expenses over. Instead, you're splitting them in half. So there's really no tax protection. And I'll talk about the tax protection in a minute when I talk about S-Corps. But in the LLC, PLLC partnership situation, you're not getting like some sort of tax benefit by having it operating. Instead, the value of it is there's some limited liability protection. And that's why it's called a limited liability corporation or partnership or whatever. And so you get some limited liability protection. It's not a lot, it's some. But it's good to use in the early days of the business because you don't have a ton of revenues yet and you're just getting started out and you just need that liability protection, but you don't need much more than that because from a tax standpoint, it's still pretty minimal in terms of what you're paying through the business and all that sort of jazz. So it helps like define the business. It helps kind of turn the business into a true operating entity, but you're not doing much more than that by operating as an LLC. Hopefully that makes sense. The third entity we'll talk about is the S-Corp. Now, this is a very popular sort of entity, and the reason being is because of the tax protection. But I'm going to tell you right off the bat, it doesn't mean it's for everyone. Just because there's tax protection doesn't mean that you should immediately jump into the S-Corp, because the reality is it's only protecting certain companies and certain size companies. And so in order to understand that, we have to understand what an S-Corp does. Essentially, what an S-Corp does is separate you out. You are now business owner of the business, and you're an employee of the business, okay? So this is in small S-Corp, so like one person, two person S-Corp situation, where you're not just investing in the company, you're truly operating in the company. So now you are business owner and employee. And as the employee, you have to pay yourself a salary. And in order to pay yourself a salary, you have to run payroll. And so every month, every 2 weeks, sometimes every year, you're running payroll to give yourself money. And when you're doing that, what you're doing is paying Social Security and Medicare costs. This is a 15.3% up to the Social Security maximum limit, which is like, I think, maybe in the 180,000 this in 2026, just above 180,000. And this is what it gets labeled as self-employment tax. And the reason it's self-employment tax is because that 15.3%, when you work for a business or a company, they're paying half of that for you. But when you work for yourself, you have to pay all of that. And so since you have to pay all of the 15.3%, that's why it gets labeled as that self-employment tax, and it adds a big tax burden, especially as your income and revenues rise. And so what we can do is set a salary, a legitimate salary for you, and there you pay the self-employment taxes or the Social Security and Medicare taxes. But then as the owner, you can also receive what's called distributions, and that money does not get that 15.3% tax. And that's the real value in the S-Corp. But it's not for everyone because you have to pay yourself a reasonable wage. That's how the IRS defines it. There's no real definition of what's reasonable. I've had clients come in with like $20,000 on $200,000 in revenue, and I just warn them, like, this could be a flag. You are basically not giving yourself a reasonable wage potentially, and we need to kind of change that. So we're not shorting the IRS, and we're not undershorting your future because now you're not paying into Social Security. But the reasonable wage should be based off sort of where you are, how much you make, and what you do. And there's certain formulas that you can use for this, which I can go in at another time. But in essence, if you're paying yourself a reasonable wage and you're paying yourself distributions, you can save on the taxes. But what does that mean? Your company has to make more than that reasonable wage. Because if you're not making more than that reasonable wage, you're getting no benefit from the S-Corp design. And by making, I mean profits. I don't mean revenues. So let's say someone makes $100,000 in profits in a business, but the reasonable wage for them is $90,000. So they're paying themselves $90,000. They're paying Social Security and Medicare taxes on that. They're saving 15.3% off the $10,000 that they're paying themselves via distribution. It's not a panacea of savings in that case. Let's say now you're making $300,000 in profit and you're able to pay yourself $120,000 in salary. So now $120,000 is exposed to the self-employment tax and $180,000 is through distributions, and now you're saving significant money. And so that's what we really want to see, and that's because when you're running an S-Corp, you have extra costs. Again, I mentioned payroll, but also you have to file a corporate filing come tax time, and those are going to run $1,000 to $2,000 for you when working with the CPA. And so CPAs put people in them sometimes very fast because of that. And so you have to be careful. You don't want to rush into it, but for when it's the right time, it's a great thing. But it's not like you get a medal just because you have an S-Corp or anything like that. It's a tool, and that's how you should kind of think about it. And then now let's talk about the most dynamic and largest and frankly the most time-consuming version of entity formation, and that's the C-Corp. And the C-Corp is unique because of all of these, it's the only one where you're taxed twice, because you're taxed a corporate tax rate, and then you receive pay as an employee of the business if you're working within the business, but you also receive dividends as ownership shares of the business, and you can, when the shares are sold, you can even earn capital gains on the sale. And so there's many different ways that taxes play into a C Corp, but I think the best thing to understand about the C Corp is that they are best for situations where the company is going to grow, they're going to add new investors, and they're eventually going to be sold. Because if you think about what the C Corp is, it's creating an entity that can live way, way, way beyond you and expand way, way, way beyond you. And you can use the biggest companies in the world as examples of that, because they're all C Corps pretty much. And they are giving out shares, they have shareholders, they have investors, that sort of thing. They don't have one single owner for most companies, although some of the ways that they've been structured, owners are holding a lot more ownership shares than they probably should be, particularly like places like Facebook and Amazon and places like that, because they've now come up with ways to do that. But in a smaller company, that's really what you're trying to do, and then it's easier to sell because now you're just passing off the shares that you own as opposed to the entity itself. Even though you are passing off the entity, it's the entity lives and your ownership is through the shares. And so it's really good for the sell situation. But for most service-based businesses, that's never going to happen, or that's not going to happen for many, many years, and not without the need of further investors. And an S-Corp can also operate the same way. And so when I see service-based businesses where it's basically the owner is the business and yet they have a C-Corp, I sort of raise my eyebrows and say, what's the point of this? And oftentimes there's really not a lot of point. And so you really have to want to have a reason for the C-Corp in order to have it, because there's also significant reporting requirements, and you also need a board of directors. And so since you need all of those things, the C Corp is often too much work for the reward for most service-based small businesses. not to mention the fact that you're taxed twice, both at the entity level and the personal level. So all of those things combined, you just have to be very careful if you're going to operate in a C-Corp. And I mean, the other thing about the C-Corp is that it kind of works like the S-Corp, where you're having the corporation filing by March 15th, and you're also filing your personal taxes, because you're no longer part of the company as a tax entity. You're just receiving it as dividends and or salary if you work with the company. The takeaway from all of this is the entity only matters in that it's there to protect your business. It's not something to create or achieve or anything like that. It's just a tool. And so if you treat it like a tool, you want to select based on where you stand, where you're going, and where you want the business to be, what you want the business to become, not what seems, quote unquote official, or sort of in your mind, sort of what you imagine the entity to be. I hope that makes sense. Now, I don't want all of these sort of advice episodes to be just like dry advice and I want you to be able to listen quick, but I also want to give a little bit of fun to this. And so I mentioned you'll hear me mention in future episodes, like I'm a very big movie fan. Like I watch a lot of movies, I love cinema, and I'm watching really old movies, really new movies, everything in between. And so if there's something that kind of fits the mold here, I'm going to bring it up from time to time and just talk about sort of the impact of my experience seeing the movie through the eyes of our goals here at Thinking Solo. And so I wanted to call attention to a 2025 film. It's a small film called The Mastermind. If you've heard of Kelly Reichardt, you know that her movies are a little slower. They're often methodical looks at a slice of modern life, even if it's set in a historical time period. And she's the director and creator of The Mastermind. And in this, Josh O'Connor plays a dad with 2 children, and he has very little ambition. You see him kind of sitting around a lot, not doing a lot during the day. And then, not to spoil the movie, because we're not doing that here, you find out in the first few minutes, he then tries to steal some local art. And he engineers a heist of some, art at his museum that he goes to quite often. And it's an interesting look at the apathy and lack of desire and frankly boredom that can lead to such a decision, and that's really, Riker is really good at pulling out the reality of certain situations, and she's basically highlighting the idea that, at least from my impression, highlighting the idea that, we imagine these heist movies and these masterminds as these really smart, intelligent, really methodical criminals, but in fact it's often just mundanity and very quick and also not really well thought out. And the person who's doing it is often not really thinking all the way through. And it really strikes me apropos here is because so much of what we do as solo business owners is try to create and move forward and provide something of value. And of course that's monetary, but also professionally or even something larger like philosophically or anything like that. We're really trying to create value for our clients. And it creates a drive in us internally, or we already have it internally, but it's a way we express it. And when I'm watching something like The Mastermind, where Josh O'Connor plays it, perfectly, in the sense that there is little drive and there is little thought of what this will bring, other than kind of a sense that he has a lack of desire to live within his father's sort of design. And if he had something that he truly strived for, cared about beyond, robbing the local art museum, then he would have been able to put a lot of that energy towards something of value, as opposed to, what ends up destroying his family. And it just struck me as something that for those who are okay with slow, methodical films, then you might want to check out The Mastermind. That is the end of today's show. Again, you can find me at YouTube at Thinking Solo. I'm on LinkedIn under my name, Ryan Derousseau. Be sure to subscribe. Thank you for listening, and I'll speak to you next time. In the meantime, keep grinding.